Okay, this is somewhat of a continuation of 11, the last chapter. Here we talk about other decisions, and in particular, how do you make pricing decisions? How do you decide what the right price is for a given product? I do also want to say that because we have 3 chapters today, I don't want to give you work to do at home after class. We won't be going through the any of those MyLab problems. I strongly recommend you do them. I have both classwork problems and homework problems set up for you. So do them. We won't be doing them in class. I won't be collecting them next week because you should study. But know that they're there. We'll talk about short-term and long-term pricing. Talk about something called target costing or target pricing. Talk a little bit about cost incurrence and locked-in costs. Talk about cost plus costing, done quite often, or cost plus pricing, done quite often in government work. Talk about life cycle budgeting and life cycle costing. Where are our Pfizer people? You may not want to nap during that one. We'll talk about non-cost factors in setting price. And then we'll talk about some of the legal implications of pricing. As we do in a lot of our thinking in this class, we start from the strategy. Clearly, the 5 forces affect your pricing, right? Going backwards. Your customers. If your customer power is strong, that will affect your pricing to a great degree. They will be defining what they're willing to pay. If you're a differentiator, you have more power over your price because there's not a whole lot of competition for your product because you have a unique product. The competitive landscape, whether you're direct competitors, potential entrants, or substitutes. Those 3 things establish alternatives to your product. If these powers are high, then that will put pressure on your pricing. Your suppliers affect your cost structure. And so, while pricing based upon cost is very dangerous because the market should define price, you need to price to make money, ultimately. And so suppliers will affect both your costs and your ability to get supply. Cost leaders outperform competitors by producing at the lowest possible cost, consistent with quality. Differentiators can create value through innovation. So price or cost leaders will try to find the lowest cost structure they can within quality and then price off of that. Differentiators will develop the differentiated product and then find the market for it. Figure out what the market will bear for that differentiated product. Let's talk about short-term pricing. We'll define short-term as less than 1 year. They could be one-time special orders like we just did in Chapter 11. They could be decisions to change your product mix or your volumes because competition has changed. Just like we just saw, fixed costs are irrelevant in the short term. Things like R&D and design will not change. got an example. You produce tomato sauce, and you produce 500,000 cases a month. Well, you have the capacity to produce 500,000 cases a month. You're well below capacity at 300,000 cases. Del Valle has asked you and 2 other companies to bid on supplying 150,000 cases for the next 4 months. You have the capacity, right? That's not an issue. So the question is, what price should you commit to in that bid? Well, here are your costs. $38 in variable manufacturing. You have a variable marketing distribution of 13, fixed manufacturing 14, and fixed marketing distribution of 15. Uniquely, you'll have an additional $165,000 in fixed costs if you do this. And that's manufacturing costs. The other costs don't change. And these, so let's look at the relevant costs from our variable manufacturing and our fixed manufacturing differential. This is the difference in fixed manufacturing, right? Based upon the 165,000 additional cost, 150,000 units is this, $1.10. So your total relevant costs are $39.10. Therefore, that doesn't tell you what your price should be, but it does tell you what your lowest price can be. You would never consider selling for less than this. You're essentially your incremental cost per unit. So anything above the $39.10 is a potential price. And then you have to look at other things. What's Del Valle going to do? Are they buying it, then they're going to relabel it and sell your tomato sauce as theirs? That's a problem, right? So you have to look at some of the other issues with this. Oh, there you go. So will they try to undercut you, which they can do because they're getting it at a low cost. Okay, so this is just a continuation of what we had previously talked about. Now let's talk about long-term pricing. Greater than a year. In this case, you would consider fixed costs because the assumption is you can manage your fixed costs in the long term. You could sell factories, etc. And so you want to price to get a reasonable return on your investment. And you could have prices that change with the market. Your goal with long-term pricing is to create a vision sort of like this. The trade-off of price and quantity. The more you sell, the lower the price, the more you'll sell. What's that? Well, I think no matter who you are, if you're differentiated, you'll probably be up here. If you're a cost leader, you'll probably be down here. It's still the same curve, and you see you're not exactly on the curve. This is not perfect data. So what you want to do is find that point on this curve that creates a maximum. The maximum relationship between price, maybe it's this point right there, price and quantity. That creates a maximum for you, where your overall value is the greatest. There are a few different ways. So now we're going to focus on long-term pricing, and there are a few different ways to do it. One way is cost-based. You figure out how much it costs to produce something, you figure out your rate of return, and you price off of that. And hope that price matches the market's needs. If you're going to do this, if you're a cost leader, you've got to manage cost out of your production process in order to make that happen. Market-based is the opposite. You figure out demand and competitors' reactions, and you price based upon the market. There's something called target pricing, which we'll talk about in a minute, which goes ahead and says, let's figure out what the market will do, and then let's work backwards to how much we could spend so that we get our rate of return, and let's design a product that will allow us to be in the market. We'll see that in a moment. Very competitive markets ultimately have to be market-based. The consumer's deciding. Airline tickets. If it's a less competitive market, it could be either. Professional services. It's not cost-based, right? When you bid on a consulting job or you bid on an accounting job, you are concerned because you know that others are bidding as well, so you have to understand the market. But if you believe you have a unique product, you'll also define what you want, what you think is a fair amount for your services. Ultimately, you have to look at cost first. You have to decide your price based upon cost. You need to make money. Let's do an example. Letitia Computer Corp makes simple and complex computers. They are pricing in a long-term time horizon. Materials vary with units. Labor varies with labor hours. Labor costs vary with labor hours. These other categories, it's ABC based. They vary with their chosen cost driver. You know your costs per order for ordering, your cost per inspection hour for testing, and the cost for rework if a unit is not up to standard. Based upon what we know, the cost per unit is $450 for materials because you do a lot of component buying and you put it all together. And labor is 3.5 hours at $19 an hour. So the total cost per unit is $560.50 plus these costs. Looking at, yes sir. Right. That's only for units that require rework. And we'll see that. The number of units requiring rework were 8,000. The number of hours of testing were 3 million, and the number of orders were 17,000. $7 million of fixed costs were included. So let's see what the total cost of producing the 100,000 units are. You take the direct material and labor that we first calculated for the number of units, the fixed cost, which you saw was 7 million, and then you add in your ordering costs, your testing costs, and your rework costs for those units altogether, and it costs 66 million or so to produce. How much should we charge? Well, there were 100,000 units. It's $662.80 cost per unit. It's because the rework is absorbed by all the units. So we can charge something greater than this. You won't charge less than that for the long run. Remember, we include fixed costs in the long run. So if you're going to do market-based pricing, you need to understand customers and competitors. You have to understand your competition from other producers. If you have commodity products, it's all about getting them out the door, so you need to be very careful with your pricing. Think about an airline seat as a commodity product. If an airline, isn't careful and they overcharge for seats, they can have empty planes because you have a choice. Which is why when one airline makes a change to lower a price, they force everyone else to make a change immediately. The risks are too great. It's very important when we talk about cost. We're never talking about giving up on quality. We'll have a separate section in a few weeks to talk about quality and cost and how they're not mutually exclusive. They actually go hand in hand. So don't think there's a trade-off between quality and cost, because we will see that that's not in fact the case. So when you're doing market-based pricing, the way to do it is you have to first establish what you believe your target price will need to be to win. If you're a consulting firm and you want to win a project, you would, which is the way I think, you call it a win. If you're selling a product, you think, what price do you need to get to be successful in the market? Okay? So it's your estimate of what that price would be based upon your experiences of how the customers would perceive your value, or if you know your competitors well enough to know what they would charge for a similar product. So once you start off with that target price, you then have to figure out your cost. You go backwards. So then you need to develop a product that would satisfy your customers at that price. So you work backwards from a target price. You derive the cost by looking at the target price, subtracting out your income, what you require to be your income, and that's your cost. And then you engineer a product at that cost. That's target pricing. So in order to do that engineering, the first thing you need to do is understand your processes now and what you produce now. And then you do value engineering, something we talked about early on. Look at your value chain and figure out where you can improve it to reduce costs so that you can achieve your target costs, which will allow you to achieve your target income at your target price. That's target pricing, target costing. Okay, so let's use Letitia, because that's what we're doing in this chapter. You want a 15% operating income on sales. You expect that you could sell your units in the marketplace successfully at $750. What's your target cost? Simple math here, right? I won't make you do it. $637.50. It's $750 minus your income. And that's what your cost can be. But we saw previously that it costs us $662.80 to produce these units. We have a problem. It costs us too much to produce at the price we think the market will bear and still get our profit. So value engineering. Go through your value chain, understand what matters, what doesn't matter, and you do a business process re-engineering, BPR. How can you engineer costs either out of your product or out of your process? It's always best to look for costs that are non-value-added costs. They're not adding anything to the customer experience. So if you have costs that are not adding to the customer experience, those are where you can save money. And that's just what we just said. So a value-added cost is a cost that, if it were eliminated, would reduce a customer's experience or the value that the customer perceives. A non-value-added cost would not reduce their experience. It's really a cost a customer is unwilling to pay for. But you need to be careful, right? Because let's say you're Coke and Pepsi. You can easily say marketing is a non-value-added cost, right? But in fact, marketing creates an experience for the customer in a subtle way. And so marketing is a value-added cost for them. It's subtle, but it is. So, because the customer's perception is not just based upon what's tangible and they feel, it's based upon an entire experience of the product. So you need to be careful as to what is value-added and what is not value-added. Having your call center in New York City at very high employment rates is probably not value-added if you could send it out to Iowa and have lower rates for the same types of people doing the same type of job. That's a non-value-added process. Now, of course, there are some things that you have to really decide. Preventative maintenance, is that value-added or not value-added? The customer doesn't feel it, but you know that if you don't do the preventative maintenance, at some point they will feel it. So you have to think through those things. You know what? I'm going to pass on cost incurrence and locked-in costs, okay? So it won't be on the exam for those of you who care. Just more or less says that a lot of costs, particularly, let's say, in a company like a pharmaceutical, R&D, at the point of R&D, you define the process that you need to go forward. So you're actually defining your cost structure very early in the process. And if you do that, you lock in those costs early, and then your challenge is to sell product to get at that cost. In a pharmaceutical, because their R&D costs are so high, they're locking in the vast majority of their costs way early. The cost of production is relatively small, but they better sell a lot of stuff to absorb the cost of the R&D. That's kind of what we're talking about there, but don't worry about it. What are some of the problems with value engineering and target costing? Employee frustration, either because of a failed target or because of re-engineering that is often painful. A cross-functional team may over-engineer. I think the next slide is going to give us a chance to see that. To accommodate the wishes of team members, the concept of groupthink. Everyone gets together and they say, wow, we need this, we need that, isn't it going to be wonderful? Before you know it, you've over-engineered things. And then, of course, the opposite of teams working too hard and group thinking is teams trying to get together to solve problems and conflicts. The engineers say the problem's on the factory saying the engineers are over-engineering things. They're all saying the salespeople are underselling, and so you have organizational conflict. I don't know. Should we do this? We won't do it. This is an interesting article. It's about, they redesigned the Corvette recently. Anybody drive a Corvette? You know what a Corvette is? Kind of like the muscle car. What's it, a Chevy muscle car? And they just did a redesign. They got great reviews. Not that I know. And it was done from scratch with a cross-organizational team that designed everything into it. Let's see if it makes money. Okay, that was market-based. Let's talk about cost-based pricing. This is where you have a cost and you add a markup to your costs to determine what your selling price is. In some cases, projects, if it's a service organization for the U.S. government, let's say, are defined as cost plus, whether it's service or even, Lockheed Martin building a new airplane. Take your cost and add 10%, that's your profit, and go from there. There are some problems with that, right? We'll talk about those. So when you're doing cost-based, you need to decide what your rate of return is. You have your cost, and then you're adding a rate of return. 10%, 20%, whatever the right number is. Then you have to decide which costs are you including. Is it just variable costs? Is it all of your manufacturing costs? Is it all of your costs? Should the project also absorb a piece of the general overhead of the company? It makes a big difference, right? If you're on a government contract, your choice here affects the bottom line. Most firms will use full cost. That was just a stretch, right? Okay. Most firms will use full cost to make their pricing decisions because it allows them to recover all their costs. I mean, you could use variable cost and just have a bigger markup, but there's more risk to that. And it's simple because you have your full cost because we all use absorption costing by definition because of GAAP. Okay, let's use Letitia. Let's go back to Letitia. They've gotten the cost down to what it needs to be. They now want to get a 20% markup on that on their full costs. What's their selling price? Can you guys do this? I hope so. Cost base, markup, selling price. Notice they're not at the 750 though. They're demanding a price. They're demanding a markup greater than what they think the market will bear. Okay, life cycle budgeting and costing. If you just use production costs to figure out your pricing in a pharmaceutical company, you'll be out of business in no time because you spend billions of dollars of R&D. So life cycle budgeting and costing looks at the entire product life cycle, not just the production cycle, to determine what the appropriate costs are. So it's from initial R&D all the way through to the end game for that product. Obviously, non-production costs are if you're going to use life cycle costing, non-production costs are a significant component of your cost structure. And the period of time is long. And as we said before, you're locking in your costs based upon that R&D early. You guys get that? So some of the other important decisions in pricing. Price discrimination. if you charge different customers different prices for the same product or services. It's illegal if you're doing it to limit competition. Peak load pricing, changing your prices based upon how you're doing versus your capacity. If you're hitting capacity, you'll increase the price, right? Because if people want your product, they should be paying more because you're at capacity. You have more. You have in the supply and demand curve, supply is not meeting demand. So therefore, it gives you an opportunity to price. That might happen for seasonal type products. One that comes to mind would be oil and gas, which tend to go up in the winter for heating fuel. Price discrimination would be deliberately lowering prices below your costs in an effort to drive competitors out of the market. And then once you've done that, you've changed the supply and demand curve, and you become the supplier of choice, and then you could redefine prices. Anyone know where that's been done recently? Or not that distant past? The U.S. steel business in China did this. I apologize to any of our people here who are Chinese, but that's what happened to the U.S. steel business. China came in with predatory pricing on steel, essentially shut down the U.S. steel business, and now we go overseas to get our steel. With apologies. Dumping, which is pretty much the same thing. You sell a product in the U.S. at a price lower than in your home market with the same purpose. Collusive pricing. Where is this done? Oil and gas, OPEC. Companies conspire in their pricing and production decisions to achieve a price above what would normally be the appropriate competitive supply and demand price. Where else was this? This was accused, I think it was it baseball or football? Where there was football was it? Where there was an accusation that the owners were in collusion to establish lower prices for labor in terms of hiring hiring football players. And that's it. We're 2/3 of the way done. And we will have time to do some kind of a math problem in class.